M15, Leadership in the Evolution of Mobility. Sydney, Australia. Kevin Frohbus, Associate Director, Burton Andrews, Senior Manager, BDO. Mobility and Taxation in Australia. IFRS, FBT and even vehicle registrations will be affected by the emergence of this mobility trend. As Australia's foremost advisory, BDO are able to provide the right information to minimise your tax burden while ensuring full compliance with your reporting obligations.
Thanks, Shane, and good evening to everyone. So hopefully you've had some refreshments and are all fit to listen to me. I must admit that my slides are not going to be as exciting as the ones you just saw. As you know, tax and accounting is not necessarily the most exciting thing. But as you know, the only two things that are certain in this world, death and taxes. So I think come what may, I think we will end up having to kind of deal with taxes in some way or another. Mobility, I think this is the word that I've been constantly hearing from all three presenters now. And does it impact the tax or does it change the way we are going to do tax? The answer to that, I think from my personal view, is probably yes and no. But probably these are the areas we will probably touch upon. Income tax, fringe benefits tax, which is quite relevant when we talk about cars. A little bit on the GST. I'm not a GST expert. I deal more with income tax and FBT. And my colleague Kevin will talk about the IFRS and the impact that the new IFRS will have. There was a research that was done, I think, by Deloitte in Europe, and their view is by 2021, they expect 63% of the new cars, to be owned under the corporate channel, and the balance 27% by individuals or by owners, which kind of leads to the view that you're going to have more cars on the company's balance sheet, or that's an opportunity for a lot of the fleet management companies to be able to provide that service. I don't necessarily have the data for Australia as to what it's going to be, but given that you're going to have a significant portion of the cars that are going to be with the companies, does that mean that we are going to have a bigger budget or bigger allowance, be it a car allowance that is being provided to the employees, or talking about mobility, is it going to be a mobility budget that corporates need to be aware of, given that there's going to be less ownership and possibly what I can hear, and most often when I do tax, I always try and understand what's the commercial reality behind it, and also to an extent what the legal transaction involves, so we can then deal with the tax issues. If we are going to have a significant portion dealing with cars on the corporate side of things, it kind of makes me think that it's probably going to be lesser of a car allowance being provided to the individual or the employees, and will lead to more companies dealing with mobility. And I think Mace touched upon it, that mobility doesn't necessarily have to be just with cars. It could be anything. It could be me having access to a public transport. So we're not restricting ourselves just to cars here. So if I were to look at it from an income tax perspective, so as I said, increase in corporate fleet and company cars. We're going to have sharing instead of owning. What model we previously always had is a novated lease, whereby an individual goes and takes a car for his or her, obviously the intention is to use it for business purposes, but nevertheless, the way it ends up happening is when you have a car that is assigned to you, you would always take the car home and it's there with you over the weekends. So that's to do with sharing instead of owning, which means we're probably going to look at having more cars that are pooled cars as opposed to having cars that are just only with individuals. This is a concept that I probably came across in terms of full service leasing. What does it mean? Does it mean that car companies or fleet management companies are going to restrict themselves not just to providing just the hardware, just the car, but they're going to deal with the entire circle of things. And does it change anything? As I said, I don't know if it changes anything from a tax point of view, but what will be interesting is that if I don't necessarily need a car throughout the year, and I only need it for say 2 to 3 months, then I can just go and talk to the fleet management company and just say, you know what, I'll just pay you to hire the vehicle. I don't want to have a lease. I mean, again, it all depends on what the contractual arrangement is. But if I want to hire it, and then I have employees using it, so as opposed to me just using it, it will be me and Kevin using it if video were to use that concept here. So that is something that will try and determine how we determine whether a company can claim a deduction, whether it's an income tax issue for the company or it becomes an FBT issue. And then we saw mobility as a service, but I'm thinking, what about leasing as a service? I mean, we've been speaking about software as a service, and I believe increasingly people or software companies try and work out not selling it as a product but as a service. It is possible that leasing will become as a service. So from an income tax point of view, again, nothing probably changes much, but it's something to be aware of as to what the contractual arrangement will be to determine what the income tax implications will be for the corporate entity. What I've put here is the conventional arrangement that you normally would have seen. You have a sale and lease back, the hire purchase, operating or finance lease, although I think operating lease probably we won't be talking about it much, chattel mortgage, leases of luxury cars. These are the things that we have conventionally dealt with when a company hires or leases a vehicle for the use of its employees or by its employees. Again, in terms of mobility, does it change? Probably not. You would still have a similar arrangement in the sense that if a company has got a car and it thinks that it's better to not own it but actually have it as a lease, then potentially you might have the option of selling it to the fleet management company and then leasing it back. I think again, hire purchase or these things, these type of arrangements, I suppose, will still remain there. But what I think will happen is the way you would do your income tax treatment or the way you would claim a deduction or the way you treat it in your books will entirely depend on what the contractual arrangement is. And I think the last one on that point is about the tax impact of the new accounting standards on leases, which Kevin will talk about. Again, most often you would follow what the accounting methodology is, but tax doesn't necessarily follow in all situations what the accounting standard does. So there can be a difference between what the accounting does and what tax does, which means you may probably have to adjust for it by way of recognizing a DTA, which is a deferred tax asset or a deferred tax liability. So those things, again, you just need to be aware of when you are entering into potential new arrangements. Keeping in mind, yes, we are going to do the same thing, but if we are talking about mobility as a service or a new concept or the way we do cars, as opposed to having, each employee having a car, we're going to have for 100 employees just 50 cars, just as an example. So it's based on usage. And I think, I don't know whether Mace touched upon it, the concept of, if I've got a car that I use it as a sedan, I use it for only 8 months of the year, but during the winter time I like to go to the snow, so I probably prefer to have a 4-wheel drive. So do I have that flexibility there? I think that's what we're talking about. But from an income tax point of view, I don't think that changes anything. I think it still remains the same because you still have the car on you. You've got it for a business purpose, and hence to the extent you're using it for a business purpose, you should be able to claim a deduction. I think this is probably quite relevant in terms of what does it mean if on the one side we are going to have more cars on the company's books. Does it mean that there's going to be an increase in salary sacrifice arrangements? I think it's quite common these days that we do see a lot of the employees trying to enter into salary sacrifice arrangement for cars. But at the same time, where my dilemma is that if it's going to be a pooled car, you don't necessarily going to have a salary sacrifice arrangement or a novated lease. So you probably have a common pool of cars that the employees use. One point to note is that there will probably be additional record keeping. But having said that, I think with increase in technology, telematics, we probably have to engage some kind of technology, or there is something out in the market that will capture that if I'm using or Shane's using, we at the end of the year when we come to do the FPT return, we know who has used it for how many days, how many kilometers we have traveled. Especially if you're using the logbook method or the operating cost method, we need to know. So I suppose we will have technology that will capture it efficiently as opposed to sitting and writing it down, because that could be additional compliance burden for the companies, which, as I said, is relevant. What the other thing could happen with a pool car is typically when you have a car for yourself, it's a car fringe benefit. But in certain instances, if you have a pooled car and it's probably used only for less than 3 months, it may not be a car fringe benefit. It might potentially be a residual fringe benefit. So those are the differences we need to take into account. The other thing to note is there is a difference in the FPT between cars and motor vehicles. So anything less than, generally approximately less than a ton, would be treated as a car. But what you have is motor vehicles, which are your dual cab utes, and then probably people who have read the articles in the last few weeks would have known that Toyota Hilux and I think the Ford range are one of the most high-selling dual cab utes in the country. That previously people were only using it for work-related purposes, but what's happened is they actually serve as a work-related purposes during the week, and they are also very useful to carry a family or go on a holiday during the weekend. They become more as a status. I mean, you can see Mercedes-Benz are also entering into the youth market. So you can clearly see there is a lifestyle change view of what a youth can do, and the tax office has recently finalized a companion guideline, because under the motor vehicle you do get an exemption if the private use was minor, infrequent and irregular, but there was no guidance on what it was. And previously I believe they used to go on the weekend and go to the soccer fields or cricket fields and note down what the youth vehicle registration numbers were, so that they can then check if somebody was saying 100% business use. So, well, I don't know whether that's right or wrong or it's the truth, but I believe that's what I heard. But what they have now done is they are saying, well, if you are coming from from home to work, it is typically a private use. But people used to then say, okay, I'm traveling to do a work. I just went and dropped my kids and came. Apparently now under the new rules, you can only have an allowance of 2 kilometers. Anything beyond that cannot be treated as private. Similarly, if you are per year, you can only have not more than 1,000 kilometers as private use, and any single return trip cannot exceed 200 kilometers. So the tax office seems to be cracking down on motor vehicles, so not cars, motor vehicles, because historically they have always been treated as being exempt. This throws a lot of onus on the employers to have additional requirement, which means you need to have policies in place to ensure that employees are using the vehicles for what they are meant to be. Reportable fringe benefits. Typically, when you have a car and the value of the private use of the car is more than $2,000, then it goes into your payment summary, and that is relevant from a Centrelink or family assistant perspective. But actually, if you had a pooled car, and if a few of us in this room use that pooled car, you don't necessarily have to report it as a fringe benefit. So on the one aspect, I think if we are going down the path of having mobility, then potentially if the way thinking is going to be that we're going to have less of individual cars assigned to individual employees, and it's going to be more around share or pooled cars, then potentially that will negate any reportable fringe benefit being reported on the payment summary. With the GST, as I said, I'm not a GST expert, but I thought I'd cover this. It's unlikely to change anything, because from a business point of view, when they actually acquire the car, they should be able to get the GST paid as an input tax credit, unless you are a financial institution, which you don't get, or if it's for private use. So most often, the GST impact shouldn't necessarily change as a result of what we are talking about in terms of mobility. The important thing to keep in mind, be it income tax, FBT or GST, the trend of mobility is still going to take time to catch up to Australia, is what I heard. From a tax point of view, always the legislation always plays a catch-up, because the way technology grows faster, I don't think our parliament does have time to catch up, because sometimes they're busy trying to work out whether you're a citizen or not a citizen, and they do have to deal with other issues. So they're probably always going to be situations where we're always going to be playing catch-up. And if you look at it from a global perspective, Australia generally is a tiny market in the global scheme of things. So by the time we fully get into mobility, we talk about legislation, it will take some time before we can see anything concrete on this. But at this stage, personally, my view is nothing much has changed. And the important thing is rules are rather getting tighter, especially from a fringe benefits tax point of view. I think that's it from me from the tax side. Kevin will talk about IFRS. Sorry, mate.
Just one question. In regards to the FBT and the determination, or the draft determination launched back out in, I think, February when it came out, they also put a positive obligation on the employer to be able to measure the product usage. That was vastly important too. So you can't just get a piece of paper from the employer saying, I only use it for 3 kilometres. You actually have to somehow measure it, which means unless you're using telematics,
that's right.
No chance of
yeah, that's a very good point. And when the draft ruling came out, everyone in the room when we were discussing this was, how is the employer going to sit and manage this? Because are we going to focus on our business that we need to run, or are we going to then sit and track it down? But I think what they've also said is that the company should have a broad policy in place and ensure that the policy is implemented well. But I fully take your point that we need to have some kind of technology to really.
Very great. The other conversation I had with someone was that they felt that the maximum kilometre limit was 1,500 a year, right, which was 10% of what we know to be the average usage of a car, which is 15,000 kilometres. So I think one of the views expressed was, if you're in a commercial vehicle, if your average kilometres is 30,000, perhaps the threshold should be 3,000 kilometres. But it's fraught with danger. Anything you step outside of that very clear determination will have FBT.
And I think it's important for employers. The way the tax office has come out is, okay, we are now giving you all these guidelines. So long as you follow these guidelines, we will not subject you for review or audit. But if they do come and audit you, then I think you should be, because the onus is always on the taxpayer to prove something. So the commissioner can come and tell you, okay, this is what it is. You need to prove that this is what was the methodology adopted, and this is what documentation I have. So that throws the onus on the employers here, and hence it's need to be carefully managed and ensure that there are sufficient policies in place to cover that. Thank you, and over to Kevin.
Thank you, Burton. Thank you, Shane. The reason why you got 2 for the price of 1 is because at some point we weren't taking advantage of the situation. It was actually that the accounting side is actually very relevant right now to what's happening. And I'm sure you all heard the concept of the new accounting standards that are coming and the new leasing standards. And so we thought we'd put that up. We initially challenged Burton to do this part of the presentation, but he declined, and that's how I ended up being brought in. So I'll just jump to the slide. I actually don't have too many slides because I could spend. Maybe you could think you can talk a lot. I can talk. I can take you down on how long I can spend on these standards, but I won't. What I actually thought I would do was actually just introduce you to the 3 standards. You would have heard a lot about the leasing standard in your line of business. The concept that all operating leases are coming onto the balance sheet for lessees come 2019. 2019 or 2020, depending on when your year end is. But I actually want to look at those 2 together because the leasing standard actually didn't arise in isolation. It actually dropped out of the revenue project a long time ago. How it's relevant to this is that these two standards don't really talk in the language of transaction and lessee. They talk in the language of customer and supplier. And that's all I've heard the whole day, or the whole afternoon sitting here. Because at the end of the day, just like tax, we can have mobility and changes and all these wonderful opportunities presenting, but all of these relationships still have a supplier and a customer relationship, and as Burton said, there's going to be a contract somewhere along the way. These standards talk in the language of contracts between suppliers and customers. You're going to see it there, contracts with customers, and then leases, they talk about supplier and customers. It eventually becomes lessee and lessor as you delve into it, but it's really about customers and suppliers. The idea behind these standards is somebody needs an asset on their balance sheet and a liability. And that's where the lease standard dropped out for the lessee. So that's really one component of the change. The component is, which you would have heard a lot of, if you're a lessee, you've got an asset on your balance sheet. You might not own that asset, but it's a right to use it as actually intangible asset. It's a right to use asset. The problem with that is that with assets come liabilities. That's the only way it can sort of balance out. The first time this standard became real for me was about a year ago. The example I'm going to give you now is actually a property lease scenario, but I just want to show you the sort of numbers we're playing with. We had a company whose market cap is 488 million, and I'm telling you that because I had a look just a while ago to see where they are. And their business model up until now was to rent all their premises. And the reason why they did that was, well, just didn't see it on the balance sheet. If you want to see a board react to something, they always say what measures get is what matters. And they will bring on balance sheet in a year's time $908 million worth of asset and liability just for the properties they lease. Needless to say, there's been a board spill. I'm kidding, that hasn't happened. But taking it to the vehicle leases scenario, since then, we've been approached by a number of government departments and agencies in New South Wales, and probably our friend here who's from government, although federal level, where they are struggling with this concept of leases coming on balance sheet. And they're struggling with their leases. 3 New South Wales departments have approached us to help. The reason why they've come to us is we've actually got a tool that can help work these numbers out. But it's all only as good as the data you input. And the thing they're struggling with is gathering the information. Because the information is all over the place. New South Wales government has gone through a number of departments merging and sort of falling apart. So some of the departments have a whole bunch of little departments and agencies, and all the information is still dispersed. And in many cases, they don't have the contracts. They've got this sort of data floating around, and they've got to try and bring it back together. We're working with raw Excel spreadsheets at the moment with missing bits and pieces in it. But at the end of the day, it's going to come on balance sheet at some level, and in this case, going to be state level balance sheet. So some of the departments are coming to us, and we're talking what I would have said a small department, and they have 900 motor vehicle leases, which they've now got to try and sort to, and one of them has 2 helicopters, so that's also fun. That they lease, which have to be brought onto balance sheet. Now, it's actually a business risk, not so much just an accounting issue, it's a business risk facing them. But linking it back to the revenue standard, if you're talking about suppliers actually offering a full service or leasing as a service, the way the new standards work, it isn't just about this standard, it's actually about the two together. They work together, and actually in many cases this standard is a component of this one. Where if I'm offering you leasing as a service, which means I'm offering you the asset, but also various services around it, they need to be accounted for just like this leasing standard, which means many of the customers are having assets and liabilities pop on balance sheet, which they never saw before. In this case, I'm talking about the supplier or the person who's providing the service. And they also have assets and liabilities sort of appear on their balance sheet because just like tax to a degree, it's linked to the employee, and when the employee actually benefits from it, or when the customer benefits from it, they are rocking up with these massive liabilities because in some cases they still haven't rendered the service or the benefit. The employee hasn't enjoyed it yet, and so before they can actually recognize the revenue, they're going to wait for that to happen. And depending on the timing of how they earn their revenue from their customer, they could end up with a liability to reflect future obligation. I have an obligation to deliver the service. I may have actually provided you the asset, being the car, but now that I'm providing you the service, I've also got that. You actually split the contract up into 2 components. So the revenue, the service part, and the leasing part. So don't forget this one. This one's a big one, and a lot of entities have forgotten that one. But it's probably going to be more relevant to the future for you because of the transition that's happening in industry. What I'm hearing today is that it's a transition towards mobility. And so perhaps we're maybe not there yet, but these standards were written with you in mind. Maybe they weren't intentionally targeting this industry. It was an industry neutral thing. But the idea of this is not about the income statement, it's not the balance sheet. This is all about assets and liabilities. Like assets being, you're entitled to a benefit of some sort in the future. And liability means you've got to do something or provide something in the future. Really, the revenue and the leasing charges that fall into the P&L are the residual after that. So that's the message. Don't forget these standards. It's more about, you might be moving to a new model or entering into new transactions or restructuring your contracts, and what happens is you suddenly find yourself with assets and liabilities you weren't expecting. That can change entities really quickly, and it changes the way boards look at their business model. That entity I spoke about that leases all their properties, their model's changing because they don't want $908 million worth of liability on their balance sheet. They may as well just buy the property. That's how they're starting to look at it. I mean, granted, it's an asset and a liability of the same amount, but it's not start to change the way you look at things when you suddenly realize it's no longer just flushing through the P&L on a sort of a cash basis. It's kind of at that level. So I'll leave that there. That's really it. The other side was a little pretty picture. It just said the road ends for operating leases. But I think this forum probably knows that already. I think you're probably one of the better informed industries on the new leasing standard. Just perhaps tied to the revenue standing, depending on whether you're the customer or the supplier.